Hey, it's Derek Laughery from the Lubben Group. Hope you're doing well. This is your weekly market update as far as what is moving mortgage rates this week. We got a lot of information over this past week here. We've had two different inflation readings come out from the Consumer Price Index. You'll see it referred to as the CPI and the Producer's Price Impact, which is the PPI. And both of those indexes honestly showed pretty stable and tame inflation readings. The Consumer Price Index that came in pretty much right at what the market was expecting. The core rate, which strips out the food and energy portions of the inflation readings because those are typically a lot more volatile. And honestly, the Federal Reserve can't really control what happens with food and energy prices through their monetary policy. That remained in line and showed a 2.68% year over year. So things look pretty good there. The headline reading, which does include food and energy, that also remains stable at 2.7%. So both those readings right in line. And the producer's price index, it was a little bit of a delayed release because we did get the October and November data together, mainly just due to some delays from the government shutdown that had happened here a little bit later this past year. Those both showed pretty stable readings, but the September report was revised higher. So all in all, what that means is tame inflation is good for mortgage rates. So we do expect those to continue through here until the next report at least, and the inflation component that impacts mortgage rates will help us and help mortgage rates get better. We did also get a couple big things here at the end of this last week since our last video to you that showed the jobs data that came out. And for December, it was showing 50,000 jobs created, which was a little bit in the ballpark of what the market was expecting. However, we did get some pretty large revisions for the November and October readings on the jobs data that came out. And that showed both of those reports combined were revised lower by 76,000 less jobs than what was initially reported. November had a modest revision of from 64,000 jobs to 56,000 jobs. And then October, that was initially reported at 105,000 job losses. That was revised higher to 173,000 job losses. Now, if you remember last week, we did talk about how the October report was a little bit skewed because a lot of the layoffs that happened in the government earlier this year, that is something that started to take effect there in the October report. Basically, they were let go, but were able to stay on through kind of the end of September. So therefore, those losses would be reported in October. It's kind of why we see a big loss number that month, as a lot of that came from the government sector. And then the biggest news that's impacting mortgage-backed securities, which therefore helps the mortgage rates, is President Trump did announce that he is going to have Fannie Mae and Freddie Mac, the government-sponsored entities that oversee conventional mortgages in the U.S., be purchasing $200 billion of mortgage-backed securities over this year. So kind of goes back to what was happening during the COVID era and then after the financial recession in 2007, 2008. And what was happening then was there was quantitative easing by the Federal Reserve. So the Federal Reserve was buying U.S. Treasuries and also mortgage-backed securities. Part of the reasons we saw rates go as low as they did at that point. Now, this $200 billion by Fannie Mae and Freddie Mac isn't something that's going to push rates back into like the 2-3% range that we were experiencing during those times. However, it could be something that spurs us to go into more like the mid 5%, maybe even into the lower 5% range over the course of a year or two. Now, a lot of people's initial reactions on that is, oh, I'm just going to wait until rates drop to that point, which could honestly be a huge mistake because as rates continue to drop, prices for homes are going to increase during that time frame. There's going to be a lot more buyers that come into the market. There's going to be increases in prices because rates have gone lower and now homes are more affordable. And so the best strategy in a setup like this is to strike now, or sooner at least, while rates are still at a little bit higher levels than that, get you into the home that you're looking for and that you want to be in. And then we look to capture those lower rates when they do fully come into effect here later this year, early next year, to drop that payment back down. Because if you end up looking at a $500,000 home, for example, and the impact of this maybe equates to a 5% home increase. Now, instead of that home being 500,000, you're looking at 525,000. So you are going to end up spending more money in have a higher monthly payment if you wait for that rate drop to happen and then buy the home versus if you buy the home now and refinance that mortgage later on to take advantage of that. So lots of movements. Overall, all good things from a mortgage rate perspective. We do expect that to continue through this next year. The analyst that we follow most closely, who's been very, very accurate going back over the last 5, 6 years, and honestly even longer than that, his projection is for average rates by the end of this year to drop to around the 5.7% range, which would be anywhere from 3/8 to 0.5% lower than what we're seeing the average rates coming in here recently. In some cases, a little bit less, depending on when you're looking at the data. But overall, all good things on the mortgage rate standpoint. So you're at a very, very opportune time to look to take advantage before those rate drops take into effect, and then be able to capture a lower payment for yourself in the future. So if you want to look and see how that's going to impact monthly payment numbers for you, feel free to reach out to us. If you need to revise your search parameters and what we're looking at from a qualification standpoint for you, get in touch with us and let us know, and we can revise those going into the spring market, which is honestly kicking off sooner this year than it has in previous years. We've seen a lot more activity of people reaching out to us, more inventory starting to trickle onto the market here as well, a little earlier than it typically does. So spring market is now. Do not wait to be active and get out there looking. If you have questions on it, feel free to let us know. You can reach us at our team line at 312-731-4939, but that is your weekly market update. Hope you have a great rest of your week.